QuickBooks Online 2025, entering an invoice created from a check using the billable functionality, the check having been generated after creating a purchase order, buying inventory for a specific customer which was indicated on the purchase order. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. Let's open up those major financial statement reports like we do every time. The reports located on the left-hand side. We're in the standard reports under the favorites section. Right-click it on the balance sheet to open a link in a new tab. Right-click it on the profit and loss, otherwise known as the income statement, to open a link in a new tab. Let's tab to the right. Let's close up that hamburger and change the range for January 2025. 010125 tab, 013125 tab. Run it so it can be refreshed. Tabbing to the right, closing the hamburger, repeating the process. 010125 tab, 013125 tab. Run it to refresh it. Tabbing to the left, noting and remembering we started a new company file. We entered the beginning balances from a prior accounting system, then thought about transactions typical to a new business, such as the need for capital, getting cash, often coming from either a bank or the owner. We then bought the furniture and fixtures, our fixed assets, to help generate revenue, and then inventory. And now we're making finally some sales of that inventory. So this time we want to take a look at a link that could be created from the purchasing of the inventory all the way through the sale of the inventory. To do that, let's recap with our flowchart. Remembering this is the desktop flowchart, but we're in QuickBooks Online. This is just to look at the flow of the forms with these nice little arrows that works for any kind of accounting system. So let's imagine we have inventory. When we have inventory, we have to buy the inventory, which is basically going to be on the purchasing side of things in what we might call the vendor cycle or expenses tab. And then we're going to sell the inventory, which is part of the customer side of things because it's going to be using the invoice form and the sales receipt form. Now, as we think about this, we're going to imagine that we have the inventory on a perpetual inventory system, meaning we're tracking not only the dollar amount, but units of inventory within QuickBooks as we do the data input. Therefore, we need to make sure that we set up the items, which we have done in a prior presentation, designating to QuickBooks the cost of the item and the sales price of the item, as well as the accounts that will be impacted in terms of the inventory account on the asset side and the cost of goods sold when we expense it. So we imagine then someone came into the shop and they're like, hey, I want this particular guitar. And we're like, we don't have that particular guitar. Maybe they want some color, some particular color of the guitar. And we're like, oh, that's kind of gaudy. We don't know. I don't know if I want that in my stuff, but we can order it for you. No, we'll order. We don't say that to them. Maybe we do on the accounting side, but the salesperson's like, oh, that's great. We will order you this crazy colored guitar or something. And so then we go to our vendor, we request the guitar with a purchase order, noting and remembering the purchase order will only be used in situations where we can request the guitar without actually paying for the guitar. They then ship us those guitars. We then receive the guitars, we can imagine, with a bill in the box, remembering that the physical bill in the box could be called an invoice from that terminology, because it's not the same term as what we use for the data input form. In other words, I can take that physical paper bill and then put it into my books as a bill, which would increase accounts payable, or I could just pay the bill at that point in time. So in that case, that's what we did this time. We wrote a check form or expense type of form, paying off the bill at this point in time, instead of entering a bill for the bill that we got in the box of guitars, right? Those two bill terms are different. The physical bill we got is different than the data input form, which could be the bill, increase in accounts payable, or a check or expense form, just paying off the physical bill we've got at that point in time. So we then paid it off. Now, as we did this, when we purchased the purchase order, we put the name of the customer on the purchase order, even though the recipient of the purchase order, the person we buy guitars from, doesn't care who we sell them to. We basically wanted to have that internally so that then when I then use the purchase order to generate or create the check to pay it off, I can pull in the customer here as well by having the functionality of billable items on, which we have to be very careful of if we're dealing with inventory, because it's not a perfect system, which we touched on before and we'll reiterate again here. But I could then check off when I pay for the inventory to make it billable. And then that makes it a linkable item so that when I then turn around and create the invoice, the sales form, it'll pull in automatically as a billable item. Now, the problem is it's going to pull it in a little bit wonky here by pulling it in at cost instead of at the sales price. So we'll kind of have to adjust it. So we have to be very careful of that. That's what we really want to kind of point out and focus in on if you're trying to use this billable situation for this particular scenario. Then when we enter the invoice, we have a normal invoice decreasing or recording revenue, increasing accounts receivable, recording sales tax at that point in time, decreasing inventory, increasing cost of goods sold, the expense related to the sale of the inventory, and the subledgers for accounts receivable, breaking out AR by customer, and for the inventory, breaking it out not only by dollar amount, but by item as well. So there's a lot going on with that one. All right, so let's go back to the first one. Let's kind of follow this through and remember basically what had happened here. So let's go back to the expense side of things. If we go into the expenses, I'm going to close up the ham boogie, and let's go into the expenses tab on the left. And let's first look at those purchase orders. Hitting the drop down, we have the purchase orders. So here are the purchase orders we made. I'm going to filter. If I filter, they're all closed. So these are actually closed purchase orders, meaning we have received the inventory on the purchase orders. Now, a couple of these purchase orders had clients on the purchase order. So if I went into like this Epiphone, for example, and if we scroll down, this one didn't have any customer. So of course I picked one that didn't have one. Let's go into this one, Gibson. On the Gibson, doesn't have a customer. Okay, great. Let's go into this one. Let's go into this Epiphone. I think one of the Epiphones has one. So this one we assigned to Eric Music. So notice the customer is on the purchase order. The purchase order is just a request. So it's a request that is actually physically going to our vendor, Epiphone. Epiphone doesn't care who the customer is, but when I get the box of guitars, then I can easily compare that to my purchase order and be able to see the customer here. So then what we did is we imagined we got the guitars and the bill was in the guitars. Now, when we do this, we're going to imagine that in the icon up top, we have the settings over here in account and settings. And then under the expenses, we've got this item turned on. So we've got the make expense items billable. We turned this on and we have these as the setting. And it's going to go to track billable expenses, and income as income is going to be the check off here. All right, so that's going to be turned on. We're going to close this off. And then we went into, let's go into Eric Music. Let's go into the vendors, or no, let's go into the vendor of Epiphone. So if we go into Epiphone here, so we paid off one of our vendors, Epiphone. Once again, here's the two purchase orders, and then here's the check that we generated from the purchase orders. So if I go into the check, so this is linked to the two purchase orders. So you can see we built the check from the purchase orders. The check is a form that decreases the checking account. If it was an electronic transfer, it would be an expense type form. And so we built it from the purchase order. And as we did that, it populated these items and it pulled in the billable items. These billable items would not be there if we had not turned them on from basically the cog up top, so that we just looked at in the settings. So now we said we want it to be billable and we want the tax applied to it for the customer of Eric Music. So once again, we have a customer in a form that's not generally in the customer cycle because we're paying for the inventory at this point in time. In other words, we're going to be paying this out to Epiphone. Again, Epiphone doesn't care about our customer. The reason we have our customer on it is because this will then populate over into the customer field, reminding us that we can turn around and now invoice the customer. Now note that this is not a perfect system for inventory. It works best if you're doing something like a job cost type of system and you're working on a project, like a construction project or something like that for Eric Music, and then you were to pay for supplies or something, and then you wanted to pull the supplies into the invoice. Why is that the case? Because the supplies doesn't have a difference between the cost and the sales price, whereas these do. See right here, we have the item. This is pulling in at the cost of the item, 400 each times 50. The sales price is going to be higher than that. So you would think that when I pull this into the invoice, QuickBooks would be able to recognize that it's an item and pull in the actual sales price when we make it billable and use the account that we gave it for the item that is set up. But QuickBooks isn't able to do that for some reason. I keep thinking they're going to fix it. Instead, it pulls in the cost. It just pulls in the cost. So we have to adjust it. That's the adjustment we need to make. Now, if it was something other than an item, say it was just a category that we were paying for up top, like supplies expense, then we wouldn't have an item and the billable thing would work perfect because it would pull in at cost on the invoice, or we could mark it up if we wanted to. But I would think we would pull it in at cost and then have a markup line on the invoice for our revenue side on the invoice. So that's going to be basically the thing we have to look out for here. So we're going to say, okay, we've got this. We paid for the inventory now. This then put the inventory on the books in terms of dollar amount and in terms of the subledger for the quantity of inventory. So then let's go to Eric Music. So now we're going to go on the customer side of things and turn around and sell the inventory that we bought specifically for a particular customer. So we're jumping from the purchasing side, the expenses tab, to the sales side. And we're going to say, okay, so now we had on the purchase order Eric Music. So we could then let's go into the customers. And then the customers has this filter field up top for unbilled income. What does it mean to be unbilled income? That typically is going to come from two sources. One is going to be the billable items, meaning we paid for something, we made it billable, which means that we're basically kind of going to get refunded for it from the customer because we bought that thing specifically for some job of the customer. In this case, we bought inventory in particular to sell to the customer. But then we're also going to mark it up. So we don't want to record it as a negative expense. We want to record it as a positive income account. Okay, and so that's the other thing that's going to be an issue with this one as well, because if it was from supplies, there would be no item. So we can't tell QuickBooks which income to hit. We can only tell it one generic account to hit on the income. But with inventory, it should be able to hit the income account driven by the item that we set up. All right. So if I go down here, we've got Eric Music and then Music Stuff Store. So here's Eric Music here. Let's go into Eric Music. And then we've got then the item that's billable, the billable item. Now, most likely what we would do here is create an invoice from these items. So I'm going to say make an invoice from it, and boom, it creates the invoice, and then I can pull in the other billable item here. Or possibly if I close this back out, I could maybe check both of them off and then make it billable, create invoice from both of them. So that should pull both of them in. Or if I just want to start a new invoice, let's do it this way, save and leave without saving. What if I said plus button and then invoice, and then we're going to say Eric Music and then add Eric Music. Then it's going to add the suggestion over here saying, hey, look, that particular customer have these two billable items. Do you want to add them? We can add them individually. We can go to the link of those billable items, which is kind of cool. or I can simply add them, add all. So let's add all of those. And so this is going Eric Music. We're going to say, this populates automatically, 30 days. Let's put the date of 01/20/25, let's say. So 30 days later, can't calculate sales tax. Well, I'll do the generic sales tax. I'm not going to worry about that. I still don't know why. Anyway, but there's that. And so, should we did that 30 days later? Okay. And then, so then we have the items pulled in down here. Let's close up this bit. All right, so it pulled in the items down here, which is what we wanted it to do. And everything looks great except the rate. For some reason, it can't pull in the sales rate, but instead pulls in the rate of the cost. So let me show you what I mean. I'm going to add another line and just type in Epiphone less Paul, an ELP. So it should cost $500, and they have it up here at $400. So that's what we have to be very careful of if you try to use this billable item with the inventory. It pulls I think it's going to go to the proper account, even if we had a different sales account that we wanted it to go to, because it's driven by the item. But for some reason, it can't think to change the rate to the sales rate, even though we're on an invoice now, and it did pull in the item appropriately. That's the problem with the inventory use of the billable item. The problem when we don't use inventory and we just record an expense to an account like gasoline or like supplies is that when we pull that in, it pulls it in at cost, which is what we would want, and then we would mark it up at the bottom of the invoice for whatever our markup is. But the problem there is because we have no item, it doesn't record it to the, you don't have as much flexibility to record it to the income account you want. You have to assign it to one generic income account. So if you wanted multiple income accounts, like this is my income account to reimburse me or for gasoline versus supplies and so on and so forth, that's where you end up with a problem using billable items on normal expenses as opposed to inventory. On the inventory, you end up with this basically issue that we're looking at here. So 500, I'm just going to change this to 500. I want to change this one because the link is still good. Everything else is good, pulls in beautifully. I can see the audit trail. So, and then this one, I'm just going to copy this and I'll put it here just to look at the sales price for this one. So this one should be 400. So this is the cost. We're going to change it to 400. All right. So now our new total is 29,400. Okay. So then let me delete this one. No longer needed. Get that out of here. All right. So now we have it. So now we're at 29,000. And then on the sales tax, I'm going to add the generic 5. So I'm going to add the generic 5. If you don't have this, you can add a new rate. I'm just going to make it at 5% because we want to have it as a generic problem. So then what do we have here? What's this going to do? It's just an invoice now. So the invoice is going to increase the accounts receivable. That's what an invoice does by the total amount, including sales tax, $30,450. The other side's going to go to revenue driven by the items here, which is going to be the 29,000, not including sales tax. The sales tax is going to go on the balance sheet for sales tax payable under the person we pay, the vendor, in our case, California, of 1,450. And inventory is going to go down by the amounts that were here before the cost of the inventory and cost of goods sold. The expense for us consuming inventory is going to go up. The net impact on net income will be the increase in revenue, 29,000 minus the cost of goods sold, and the subledger for accounts receivable will break out the accounts receivable also by customer on the subledger, and the subledger for inventory will be breaking out not just by dollar amount, but by the units that are sold. All right, let's save it and close it and check that out. Save and close it. Save and close that bad doggy. All right, let's go to the balance sheet, run it so it can refresh, and then we're going to go into the A to the R, and so there it is. So there it is, 30,000 450, 30,450. I think that's right. Let's go into that one and look at it in detail. That gives us the balance. What is this doing? Stop that. Stop doing that. That's the full balance, closing that out. And then I'm going to go back. And then the other side goes to the income statement, run it to refresh it. It went into the sale of product. Notice it didn't make another new account like it would if it didn't have the item. It would have put it into a generic like billable income or something. The item drove it to the proper account here. So that's good. So it went in there. There's the two items. They both went in there for the same invoice. They do not include the sales tax. The sales tax going back is going to be on the balance sheet under the sales tax payable under the California Department, and so on. And then also the inventory is going to go down. So inventory here is going to go down because we're selling the inventory at this point in time. So all of these have to do with the inventory. So they're in there individually. None of these amounts are actually on the invoice. Notice you have multiple, like 4 items here. Even though if I go into the invoice, I only have the 2 items. Why is that? Because I believe that's because QuickBooks is using the first in, first out method. Therefore, there's layers of inventory that it's trying to calculate to get the proper cost allocated. So I'm going to close this back out. I'm going to go back up and then go back. And then the other side is going to be on the profit and loss under cost of goods sold. The cost of goods sold. There's those same items down here under cost of goods sold. The net impact on net income is the increase that happened to the revenue minus the cost of goods sold. And if we go back to the balance sheet, then the inventory is going to be impacted by the subledger for inventory, breaking it out also by unit. Let's go to the first tab, open the ham boogie, and go to the reports to check that out. Close up the ham boogie. And I'm just going to scroll down to where those reports are located. I think it's under the sales. Donde, por favor. It's under the sales and customers and inventory valuation summary. Inventory valuation summary, right click, open a link in a new tab. And then I'll also open the subledger for the accounts receivable, who owes you section. That's going to be the customer balance. Let's do the customer balance detail. Let's do the customer balance detail. Open a link in a new tab. Let's go to the new tabs that we just opened to check them out. What happened over here with these new tabs? Let's check them out, man. I want to see what's going on. 0101. Let's go 013125. Run it to refresh it. There's the inventory. Here's the new quantities of the inventory. The quantity times the cost of the inventory gives us the asset value at cost, not the sales price, $15,678, which should tie out to what's on the balance sheet, $16,678. Notice it doesn't have to tie out, meaning it's possible to throw this balance off because it's possible to record something to inventory without adding an item, which is not typically the case with the accounts receivable, in which case, if you record something to AR, the pirate account, accounts receivable, then you're going to have to add a customer, forcing the subledger to be in balance, baby. Let's go to the customer balance report and just prove that to ourselves. So we have Anderson, Eric Music, and the Jones guitars here. We just did one, I think, for Eric Music is the one. And that adds up to a total of $38,671.50. Back to the balance sheet, $38,671.50. Everything looks B to the N. Be in, baby. Let's go to the first tab, open up the ham boogie, and go down to the sales area. Once again, we can track those invoices which are now open. And the invoices here, close on the ham boogie. And then we can say the status of the invoice. We want to see unpaid invoices. And then we've got Eric Music here. If we want to go to the customers, then we can do that. And we can go into unpaid invoices. Let's go to open invoices and credits. Go into that one. And then we've got Eric Music here. If I go into that one, then we have our invoice, which was created from these billable items. Let's take a look at the billable items now. It says it was converted, right? So the billable items have now been converted. So closing that out, we can see that indication here, converted. And then if I go into my invoice and we say edit the invoice to check it out, we have the invoice that was created here. It doesn't have really the link on the invoice to the converted items. I don't as easily pulled in here, but it does have the link. Here's the link to the convert. So everything is linked together. That's the beauty of it. If you have learned bookkeeping in a textbook with debits and credits, you want to still see the debits and credits in the forms, but you can see all these added linkages that makes the audit trail so much more clear and visible from multiple different angles, which is why, whenever possible, we want to use the forms rather than just entering a journal entry, is the typical idea. There's much more linkages that's going to be involved. All right, let's do another one. Let's do it faster this time. We've got the next one we're going to go into will be, let's see, let's do it faster. Now I've froze up trying to do it faster. We're going to go back to the customers here, and then we have the unbilled income. So in the unbilled income, we've got music stuff store. So let's remember where this came from. Same kind of thing happened. This music stuff store, who is our customer, came in and said, I want this particular guitar. We don't have it in the shop. And we're like, okay, we'll buy the guitar for you. So we went then into our expenses side to buy it, and we made a purchase order. So we're going to go into the purchase orders, and we then, let's see, filter on purchase orders. And actually, let's go do it this way. Let's go into the expenses tab, and then there's our purchase orders. So we had, I think it's the Gibson one. So we have this Gibson one up here. Let's check that out. And so we requested on Gibson for music stuff store. So we put the customer on the purchase order when we requested the guitar from our vendor, even though the vendor doesn't care about our customers, so that when we get the guitars after requesting it, we know that we can turn this around and sell it. So the next step was we got the guitar, and then we could enter a bill because we imagined the bill was in the box of guitars, but no, we turned around and just paid it off with an expense or check form at the point in time we received it. So let's go into the vendors and just check that out. That was in Gibson USA. So then we entered a check. So as I entered this check, and we said it was billable. So that means that we pulled this in from the information on the purchase order because we linked the purchase order to the check, and then we made it billable by turning on the billable functionality, noting that I have to be very careful when I pull it in as billable, because although it'll help me to automatically generate the invoice, it will mess up and not be able to see the sales price versus the cost. This is the cost. It's going to pull in at cost instead of recognizing that it's an item, and therefore when I make an invoice for it, it should pull in the sales price. That's what I'm going to have to fix. But that's cool. I'm going to say, all right, close this out, go to Music Stuff Store, open up the Ham Boogie, go into the sales side of things, closing the Ham Boogie, going into the customers, and then once again, I'm going to go into that unbilled income. So we've got the unbilled income for Music Stuff Store. We can see here. We can also, we can see it right there. So if I go into that one, there it is. There's the billable expense charge. There's only one of them. Let's go ahead and just generate the next thing we would do. By the way, this hasn't recorded anything. There's no impact on the financial statement from this item. This is basically like unearned revenue, or it's revenue that hasn't been recorded yet. We haven't sent out the invoice yet. So we're going to create an invoice from it, and that's when it'll impact the financial statements, balance sheet, income statement, and related reports, right? So we're going to say create an invoice, and then it generates it to Music Stuff Store, and I'm going to do the generic sales tax, So that's right. So that, and then let's do it 123, 2025. All right, everything looks good. But then when I go down here, I'm going to copy this and put it down here and note that it didn't pull in the sales price. It pulled in the cost, not the sales price. Dang it. Make it right, QuickBooks. Why can't you fix that? What is wrong with you? There's got to be some kind of weird programming thing that they can't get that to work for some reason. It's like you should totally be able to fix that, because the item is here. I don't understand it. I feel like if I was a programmer, I'd be able to fix it. If I knew how to do stuff, then I could do stuff. I just don't know how to do stuff, but that's not my fault, because if I knew how, then I could do it. Let's actually make the date up here one day up. Let's make it 24. That's what I have in my worksheet. All right, so 1/24/25 to 2/22. Okay, so then if I go down here, let's do the generic 5 on the sales tax. Generic 5. All right, so what's this going to do? It's going to record invoice increase in accounts receivable by the full amount, including sales tax, 815,850. The revenue side going up by the amount not including sales tax, 7770. The sales tax on the accounts pay on the balance sheet liability going up by 3885. Then the inventory is going to go down by the amount that was there before we changed it, the cost that it knows about because of the item, and the cost of goods sold, the expense related to us selling the inventory, is going to go up by the same amount. Net impact on net income is going to be the sales price, not including sales tax, minus the cost of goods sold. And the accounts receivable subledger will have the information broken out not by date, but by who owes us the money, customer that is. And the subledger for accounts receivable will break out the inventory not only by dollar amount, but by unit using the first in, first out method. A lot going on, a lot happening, but it's all linked together. And I don't even have to know what's going on, and it still will happen, and I can still do it because I set up the forms right. That's how you got to get the system right, and then you can hire teenagers that don't know what they're doing. They can't stop thinking about video games or something, and they can still do it with maybe they have to have a little bit of but anyway, let's go to the balance sheet and then run this thing. Let's run it. All right, and then we're going to go into the accounts receivable to check it out. Check this thing out. So we're at 1006. There's the amount. That's the amount that includes the sales tax. Scrolling down, boom, sales tax included. Closing that out. Back up, back to the report, go into the P&L, the profit and loss, run it to refresh it in the income. We then have the income amount here, and it's put it on there for 2 line items. Neither of those. Notice again, there's only 1 line item over here. So you might say, why is it on there for 2 line? Well, no, there are 2 line items. Okay, so wait a second here. Que paso? This is hold on now. Let's go back here. This is going to be, okay, I'm on this one. So there's only 1 line item. So that went on there for the 777. So that makes sense. Okay. That's the amount that doesn't include the sales tax. Closing that back out. Go back and then back to the balance sheet. And then on the liability, the difference is going to go to the sales tax payable, which was going to be given by who you're paying, the vendor. There are those items. And then we're going to go back up. And then we also know that the inventory is going to go down. So if I go into the inventory to check it out, then the inventory goes down by these 2 items on the inventory. Did I already look at the inventory? Anyways, these 2 items are not on the invoice because this is the sales price. Right, and so I'm going to, now this is the one that I have 2 of them on here, even though it's the same number, and that's because I believe they're using the first in, first out, which has a layered kind of functionality, even though the price is like the same for the item. So I think that's why that happens, in case you're wondering. I'm going to go back to the profit and loss, run this again. I already ran it, don't need to run it again, but I'm going to go to the cost of goods sold. There's these same two items here. Net impact on net income from the invoice is the sales price minus the cost of goods sold. Plus, if I go back to the balance sheet, the inventory is going to have the subledger, run it to refresh it, breaking out the new quantity of inventory, notice I have a negative amount here. That's kind of a problem, but I'm not going to let that bother me. That shouldn't have happened, but I'm okay with that for now. We're going to say that's going to be 9698. Let's go back to the balance sheet. That's 9698. And the accounts receivable is going to have the subledger breaking out not by date, but by customer. That's over here. Running that bad doggy. So now we're on all of our customers. 46,830. Back over to the balance sheet. 46,830. That makes sense. Let's go internally to the first tab and check things out as they are over here. The billable item has been converted, and then the invoice has now been generated from it, and we have not yet been paid. What would happen next? We're going to get paid on the invoice. Let's check out the invoice. If I want to link the invoice to the thing that created the invoice, that's with this little link right here, which takes us to the linkage. So that's going to be the general idea. It all ties out. Everything's linked together in such a spectacularly crafted format, except QuickBooks can't get that sales price correct. But whatever, man. We all got problems. I can't do lots of stuff. Anyways, this is where we're at. We can work around it. We can work around your deficiencies, QuickBooks. We go to the balance sheet. This is where we stand at this point in time. And then if I go to the profit and loss, this is where we stand. Let's open up the trial balance. Go into the first tab. Open up the ham boogie. In the reports, typing out trial balance. See where we are at. Trial. Can't you spell? Can't you spell? I'm going to close this out and change the range 010125. Spelling's outdated. We're going to go down. There we go. So there's going to be so notice this is just a balance sheet on top of the income statement. We have assets going down to here because that's a contra asset. Then liabilities on the accounts payable starts there, goes down to the loans payable. Then the equity, which goes down to owner's equity. And then the income accounts, the revenue accounts minus the expense accounts, of which there's only the cost of goods sold at this point in time. Remembering that if we go to the next month, February, the income accounts will not close out to revenue like you think they might if you wanted to close out on a monthly basis, because QuickBooks is set up to automatically close out, but only on a yearly basis. And therefore, if we changed it to next year, 2025, these revenue accounts would close out to the owner's equity account. If your numbers tie out to these numbers, great. If they do not, try changing the date range, extending the date range. Drill down on any numbers that change. If they do, get to the source document, change the date to before January 31st, 2025, and see if that fixes the problem. If it does not, at the end of the first month of data input, we'll run some transaction detail reports, which might help us to drill down and find faults.